because it's vitally important that if there's a healthcare cost that requires a lump sum payment, a big bill comes your way that something doesn't cover, you want to be able to attack that with after-tax dollars. My husband and I are concerned about healthcare costs in retirement. We've got a good amount saved, about $1.2 million, but our family has a history of lots of health complications in older years. What steps should we take now to be sure we're okay in retirement? It's good that you're thinking about that, Jamie. We do know that healthcare costs are likely going to be the most exorbitant of any cost in your retirement years, and especially if you have some family history there to consider, you're going to want to make a plan for that. And I think, John, before we get to the future part of Jamie's question in retirement, there is kind of a good evaluation she needs to take, her and her husband both, of their current situation.
Yeah, at $1.2 million savings, then that's a good foundation for financial independence. You know, depending on what your income need is, I think that there's a good chance that you can sustain that income throughout your retirement with that amount of money. But you have hit on the big $64,000 question, as they used to say. Healthcare costs, we don't know really what those look like going forward. And I would say that you're going to need good coverage and a good emergency fund to try to not have to invade that 1.2 million. Think about that 1.2 million as kind of your milk cow. It's producing the milk. If you need a slice of beef for some reason, then you've got trouble in the milk processing department, right? You need to be sure that you've got that steady stream of income uninterrupted as far as your monthly expenses are concerned. You need to have an emergency fund, preferably after-tax dollars that are readily accessible to be able to cover healthcare costs. Now, that is out-of-pocket expenses, things like deductibles and co-insurance and things of that nature. You also need to be sure that you are providing for long-term care expenses. Those are all things that just on the surface, Scott, I think that's the evaluation that you've got to look at. You've got to look at acute care expenses, long-term care expenses. Acute care expenses can probably be covered with an emergency fund. Long-term care expenses probably need to be insured against.
Yeah, I would encourage Jamie and you and your husband to build a retirement income plan with a financial advisor so that you can know what that $1.2 million is going to do for you. Now, we don't know when you're going to retire. You may be years out, so we can project for you what that $1.2 million will become potentially with an assumed rate of return and your current contributions. And once you know your asset level, you can begin to see what your monthly income will look like. And you want to be able to dip into that retirement fund on a monthly basis and take monthly income. Maybe you can set that number a little higher than what you actually need so that you can begin to accumulate, as John mentioned, those after-tax dollars, because it's vitally important that if there's a healthcare cost that requires a lump sum payment, a big bill comes your way that something doesn't cover, you want to be able to attack that with after-tax dollars. And the easiest way to do that is to build liquid savings in cash that has already been taxed. Maybe it's been pulled from a retirement account over the years, or maybe you just had been able to save that in your pre-retirement years. But the other thing would be build up other after-tax accounts. If you have access to an HSA, a health savings account, start putting money into that now if you're not already, because you can pull that money out, John, tax-free for healthcare-related expenses.
Scott, an HSA is a great idea, and accessing an HSA after retirement is fine, but once you're on Medicare, you cannot contribute to an HSA. So that has to be done ahead of time. There has to be some forethought put into this. I think also, as we mentioned long-term care insurance, it's important to think about what your options are. A less expensive option for long-term care insurance initially, as far as premiums are concerned, is traditional long-term care. Traditional long-term care is a lot like health insurance. You pay your premiums. The premiums are subject to increase. Those types of things. We have seen tremendous increases in traditional long-term care insurance. And so we at GenWealth have stepped away from recommending traditional long-term care insurance unless you just can't afford anything else. What we tend to recommend is a hybrid life insurance long-term care policy because you know what your costs are. You know what your benefit is. It's very set. It's very very calculated. There is no price increase that's going to come into play like it would on traditional long-term care coverage. Well, you may say, John, I don't understand why the two would be different. One is based on claims experience, meaning that if claims experience on traditional long-term care goes up, if more people are claiming against it, and baby boomers are claiming a lot on long-term care, then you're going to see those premiums go up. In terms of a life insurance long-term care policy, a life insurance is very pre-calculated. It's very static. And what a long-term care rider essentially does is it gives you a prepayment of the death benefit prior to death to cover long-term care expenses. And so there's no magic as far as the formula is concerned there. They don't have to worry about claims experience because it's not an open-ended policy. When their claim expires, when they've used all of the life insurance, then there's no more money there. That is the downside of a hybrid policy, but you have to be in the game in order to get the benefit. And if you're not able to pay the premiums because the premiums on traditional long-term care have gone up, then that's going to be a problem down the road. You need to look at the hybrid option if it is an option for you.
Allows you to plan for the future when you know that premium is going to be level throughout. And I think the other piece to that is we like these policies too because they are for long-term care coverage, but it doesn't have to be a nursing home that you receive that long-term care from, because these policies will allow you to, if a doctor determines that you cannot perform 2 of the 6 activities of daily living, let's say you had a stroke and you can't bathe yourself or feed yourself. Those would be 2 of the activities of daily living. And a doctor says, yes, that's true. In this case, Jamie cannot do that. Then this policy would begin to pay a monthly income to you, and you would be able to use that however you choose to do that. So it may be that you're able to stay at home. You may be able to pay someone to come and take care of you. You may be able to pay a spouse to take care of you because the spouse had to quit their job or are limited on their hours because they are now a caregiver. So it's way more flexible, I think, than many of the traditional long-term care policies. But it is best to tackle that ahead of time. And the way the question is phrased, John, I think it's pretty likely that they're probably in good health now, and they're talking about a future need. So when you talk about when we should address that long-term care and go in and try to get that coverage, all things being equal, if someone is pretty healthy or at least normally healthy, the age band is about 55 to 60.
Yeah, I would say that that's the best time to begin to think about doing it. The older you get, the more problems you have. The older you get, the higher the premium is on either of the policies. And so you certainly want to be sure to look at this from a affordability standpoint and an access standpoint. Speaking of access, Scott, I think that we also have to think about the fact that, you know, the presidential election has come and gone, and you have to think about what the Trump administration may or may not do as far as the Affordable Care Act is concerned. You know, there's a lot of provisions in the Affordable Care Act that make it beneficial for people who have pre-existing conditions. They are able to qualify for coverage, where I remember the day when you couldn't qualify if you had a pre-existing condition. You might get that condition ridered out of the policy, meaning that they excluded coverage on whatever that pre-existing condition was for maybe a number of years or maybe permanently. So there's a lot there that you know, you have to kind of keep a watch on as far as the politics of this is concerned. However, when it comes to Medicare and Medicare supplement coverage, you will not be denied coverage as long as you have a timely enrollment. And you want to be sure to check out what that is. It's usually 3 months before, 3 months after your 65th birthday, or after a qualifying event where maybe you've worked past 65 and you've had health insurance coverage and now you've retired. That retirement is your qualifying event to be able to get onto Medicare and a Medicare supplement without having to prove insurability.
If you're like Jamie and her husband and you're concerned about health care costs in retirement and you're not getting those questions answered from your financial advisor, let me encourage you to reach out to us. We definitely address that as part of our planning process. You can call toll-free 866-653-PLAN. That's 866-653-7526. And we will get you in touch with the GenWealth financial advisor to begin making your plan to address healthcare costs in retirement.